Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. On today's episode, we've got Ross Healy on the show of Strategic Analysis Corp. He's been in the markets for 60 years, so he has been there and done that. And right now, he's very worried about the U.S. stock market in particular. I don't want to say how much of a pullback that he sees because I don't want to scare you off in the first 30 seconds of this podcast. But give us a second and he will walk us through his thinking on why he sees a big plunge for U.S. stocks. That doesn't necessarily mean Canadian stocks will follow. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. If you're looking to explore the world of options trading, having the right tools is essential. The BMO InvestorLine self-directed platform offers a suite of features designed to help you analyze opportunities and execute your strategies effectively. Discover advanced charting, real-time quotes, strategy builders, and risk management tools, all within the powerful platform. Take control of your options trade and explore their potential with BMO InvestorLine. Start investing today at bmo.com/investorline. Ross Healy, thank you so much for joining me.
Amber, it's my pleasure.
Now, nobody would know it to look at you, but you have been investing in the markets for 50 years. Is that right?
60.
60 years?
60 years. This June, June 30th, would be when I joined an investment dealer, Midland Osler Securities. And I joined it just for the summer, and I stayed on in the industry for 60 years.
I mean, that's wild. Then you're still as active as ever in the market. And it's so great to get that long perspective because I think there's a new generation of investors who think markets only go up and every dip is meant to be bought. And you know something about history that doesn't always bear fruit.
I can assure you that markets do not always go up. And worse than that, when they decide to come down and they're as expensive as they are today, they can come down in very cruel ways.
So generally, are you cautious about the markets here? Because I'm looking at no tariff deals so far. I'm looking at a lot of optimism that there will be tariff deals. And the market is within spitting distance of all-time highs. Why don't the markets care about tariffs? Because regardless of how this shakes out, there will be tariffs.
I think a couple of reasons, and the first one is that in a year and a half from now, Donald Trump's going to be facing election, and the last thing he wants is A, a recession, and B, a bear market. So my guess is that investors are kind of saying, well, I think we should go with Trump because he'll do his level best to avoid that. And of course, one of the things that he's doing is that big, beautiful, does he call it a big, beautiful tax bill? Anyway, whatever it is, a big, beautiful bill, which is presumably going to give the market another sort of punch upwards. Also, he's leveled these tariffs on all sorts of countries. I think he's over tariffed them. What that does is it allows him to come in and cut them back, and therefore give another vote of confidence to the market. There's this taco trade. Trump always chickens out.
Yes, don't tell him that. He doesn't like that.
Oh, he hated that, and I think that's why he ramped up the tariffs on steel and aluminum by from 25% to 50%. But the pushback that he's going to get from American business is going to be just unconscious, and so he's going to have to bring them back down again.
Which should be great for markets.
Which exactly. So he pushes them up and then puts them back, and then you see the taco trade. Trump always chickens out. We got to buy.
So are we going to be long tacos here, long the taco trade? Because I gathered from your initial remarks that you are a little skeptical about where this rally goes from here.
Well, let's put it an entirely different way, Amber. And I didn't bring the list of them, but we have a list of 10 major excessive readings on the market. Now, from price earnings ratio, price to book ratio, Buffett's indicator, there's 3 that I can think of just offhand. But anyway, there are 10 of them at all-time highs. And the question is, if they're all at all-time peaks, can they go any further? And that, of course, is the big question. Now, overhanging, or maybe not overhanging, perhaps underpinning the market has been this whole movement into artificial intelligence and those Magnificent Seven stocks that have propelled the market up and up and up. The problem is that when you look at AI and what it's actually doing in terms of enhancing business, we're not finding very much. So as long as people are investing a heck of a ton of money in building this infrastructure, that's going to be wonderful. But the moment they stop investing in infrastructure and start using it, and then we find out, well, you know, in point of fact, AI helps me to write my code a little bit faster. You got to be a bit careful because it turns out that AI is perfectly capable of lying to you, and that's not very useful.
So are people.
So are people, exactly. Well, if that's the case, then what is the adoption of AI and what is the actual economic impact of AI on the economy? Never mind the spending on the infrastructure, but the actual impact itself.
So you think
there's a big fat question.
You think that maybe we're overspending on AI and the payout is not there on the other side?
I think that's exactly what we're going to find out. But you know, Amber, we have seen this from time immemorial. 25 years ago, we had that was the last high tech peak there, and you know, everything that they said about the implementation of the fiber optic cable and the internet, it all came true. But between the peak and the trough and where we are today, there was one heck of a big decline because the economics of it didn't work as fast as people thought and hoped.
I think that's good perspective because I was going to ask, you know, someone who's been in the markets for 60 years, why you don't just buy and hold? Because over the very long term, things go extraordinarily well, and they have over 60 years. But to your point, if you're positioned in the wrong spot, it does not. If
you're positioned in the wrong spot, it can be absolutely miserable. I mean, the high techs in 2000 to 2002, they went down by 83%. Now, if you happen to be in high techs, could the same thing happen again? Sure. I look at the fair market value of some of these high techs right now that are producing all these chips. Their prices are here and the fair market value is down here. Well, I know something from being in the market for 60 years that when you get a gap like that gap always closes, and it never closes by the fair market value going all the way up there. Okay, that takes time and time and time. But what happens is the price comes down here.
So does that mean, like, let's call it the Magnificent Seven or the semiconductor sector, does that mean you don't own anything there?
No.
because of this fear.
I wouldn't, heavens, I wouldn't touch them with a barge pole. No. You're kidding yourself if you think, if you had a 5-year horizon, say, for your RSP and you were putting them in there, that's a formula for having your RSP wiped out.
That's wild that you say that, because it has been a formula over the last 5 years. For some people, it's the only reason their RSP is up.
Actually, not the last 5 years, since 2009, 2010. Those stocks have had a beautiful run.
And did you own them then? Like, I'm just trying to get a sense. Are you a perma bear on this sector, or you get in when the getting is good, and this is a timing call? Now you think we're coming to the end?
I think so. I for 6 years, I had a little webinar every Friday, which I call Fang Friday, and I reviewed the Magnificent Seven.
At that time, the Magnificent Seven was called the Fang. Yeah,
that's right. And they were a lot of fun to trade. But now they're high, and I'm looking at the market, as I say. 10 indicators say, "Look, gosh, this is expensive." Not everything, but 10 indicators say a lot of expenses. It's the time to be very, very cautious.
So one thing, when you look at the index, and we're talking about the S&P 500 as it's constructed, yes, it looks very expensive.
Yes.
When you neutralize the impact of these mega cap tech, the S&P equal weight is trading at around 18 times.
Yep.
Is that still expensive, or does that advocate for not everything is as expensive? It's not crazy.
Amber, let me tell you something about bear markets, which, if you don't know it, you ought to know it. Okay, it doesn't matter if you say, well, here's a bunch of expensive stocks and they're going to get killed. Here's a bunch of cheap stocks, they're going to get killed too. Not as badly, not nearly as badly, but they are going to get hurt as well. And the reason is that when people sell expensive stocks and they come down, they're kind of looking around. Well, gosh, I'm taking an awful licking on whatever the stock is. I better sell something to kind of balance it out. So I'm going to sell a winner well, then the winners begin to fade as well. And then, my gosh, no, I'm losing everywhere. Well, I think I just better sell. And at the end, at the very, very end, that's when you get panic, even though the panic for many cases is not merited.
Do you have a catalyst for what causes this event?
I wish I did. I've got a catalyst for what causes a bottom, because I can read those. But when you're in a top and it's kind of rolling over, the question is, what is it that, and I guess we're going to find out.
So what does this look like for you in the portfolio? Are you totally out of stocks? Are you fully in cash, waiting? What does it look like?
Our model portfolio this year is up 15%, and we have a fairly broadly diversified portfolio, and we're doing fairly decently. Thank you very much.
You're welcome. We're going to get into those names, so don't name them yet. But at a high level, tell me, what does it look like? What are the pockets you're finding safety in?
Well, first and foremost, one of the huge issues and problems is the solvency of the U.S. economy. And the solvency of the U.S. economy is getting worse and worse and worse. And if that big, beautiful tax bill goes through and there's another tax cut, what's the U.S. going to do for spending? Well, they're going to print more money, of course. And then that pushes your solvency further into a condition, actually, that we call the black hole.
These are big, like you don't actually expect that to happen. The U.S. is a world reserve currency. They have more tools than most.
Worse than that, yes. The answer is yes, I do, because I can actually see it and measure it.
Tell me how.
We look at the GDP to debt ratio, or the debt to GDP ratio, and when the amount of debt relative to GDP reaches $3.50 of debt per dollar of GDP, that's the beginning of real problems. And there have been 58 countries since 1900 that have fallen into that condition. And the U.S. is sliding towards that condition unless their Senate sort of gets their act together and says, whoa. But if they slide into it, 58 countries have done that. And what's happened? Their currencies have slid. Many of them have collapsed. Now, do I think that's going to happen with the U.S.? No, because I think that they will be forced to pull out of that and restructure, not under Trump, but they're going to have to do that.
What's your time horizon for seeing this play out? Like, you use history. How long does it take a country that, well, obviously less well-equipped than the U.S. to dig themselves out?
Okay, the whole thing started in 1980 with Ronald Reagan, when he started the first tax cut, but no spending cuts. Okay, you didn't have to spend because the tax cut was going to produce a whole lot of growth. It didn't.
Trickle down didn't work?
Trickle down didn't work. And this kept on with consecutive Republican administrations. They kept cutting taxes, and they got worse and worse and worse. Finally, in 2008, that was when George Bush, W. Bush, did the last one. And it drove the U.S. actually into that condition. And what happened? First of all, they had a nasty recession. Secondly, their currency went down. And thirdly, their interest rates went berserk. Okay, and so the U.S. has already experienced that. Then going forward to 2020 with the COVID meltdown, there was another little dip into there as well. The U.S. is just flirting with that breakpoint.
That's the $3.35.
$3.50
and 50-cent breakpoint
for debt per dollar of GDP. And wow, when you get there, I gotta tell you, all kinds of fun and games start. And they, as I say, it's happened 58 times already. So I'm not inventing it. I haven't actually seen it because I wasn't born before in 1900.
Not that old.
But nonetheless, I have studied the history and looked at these countries, and that's exactly what's happened.
You know, I just want to make sure that we're really being clear about how you see the world, because for people who come here, you know, and I challenge the bulls as well, but for people who come here and say, you know, it sounds like you're saying the world is ending, the U.S. hegemony is ending. You know, like how bad is it? Are you talking about a 2008 style event where it pulls back? Because we almost had a bear market and investors swooped right in and said, nope, I'm buying this dip.
Yes. The if I go back to 2000 and I take a look at that market, 2000 to 2002, the market came down in big swinging steps. And with every down, okay, then there was a lovely up. And people said, see, buy the dips. Okay. Well, that continued on for 2 years. And then finally we got down to the bottom in July 26th of 2002. By the way, I happened to be on ROB TV, BNN television that day.
Oh, wow.
And Jim O'Connell, the moderator, asked me what I thought about the market. I've been bearish. And I said, Jim, the market hit bottom. Okay, it bottomed at twice book, and it basically the market stopped going down because the market had got so cheap that it could do nothing but go up, and then proceeded to go up for years and years afterwards.
So you can be bullish. You're capable of being bullish.
Heavenly day! When it's time to be bullish, I will be very bullish.
So let's talk, since you're good at bottoms. Let's see. Can you tell me like what you could foresee a pullback in the S&P 500? Like what would be a level that you'd say, okay, we've fully washed out. Right now, the S&P 500 is floating around 6,000.
Yeah. Okay. Curiously enough, Amber, if we go back just to 2020, okay, the S&P bottomed at 2 times book. It's now about 4.5 times book. So that is that would be the degree to which I could see downside for the Standard & Poor's.
Okay, now I have to go back on my charts because I want to know the number. Like, what's the magnitude of the drop? If we retest those COVID lows, that's what you're saying?
Well, it's got to be more than 50%, put it that way. Yep.
Okay. Yeah, I'm going to do it too on my little chart here. It would be, I did it wrong. So you say more than 50%.
For the S&P, which is heavily weighted by the NASDAQ. This is not to say that we're going to get a collapse across the board, but I'm simply pointing out that that's where the Standard & Poor's stands today. It could, could
it's like
be
62%. I had to do the math to the
Okay,
COVID
yeah,
low. That's a big drop.
Well, yes, but look at the NASDAQ. I look at the fair market value of the NASDAQ, and the fair market value of the NASDAQ itself is 40% lower than where the index is today. So sure, it could there could be, and by the way, the NASDAQ has this tendency that I described. Your earnings trajectory is going up in one plane, and your price trajectory is going up in this plane, and those always close
down
by coming down. They always close by coming down.
Alligator jaws, I think Francis Hordelsky called them.
Well, I call them the jaws of death when I'm talking to my clients, but that's what they are. Yeah.
Okay, I feel like we've scared everybody enough. Let's talk about some stocks and how this is going to show up in some stocks.
All right. Can I start off by pointing out an area which I am very bullish on?
Yes, please do.
And it's gold and precious metals.
So I remember talking to you about gold and precious metals, and we actually have a question about this in the mailbag.
Yes.
So let me start with this question. I'd like to know if it's time to take profits in gold. This one coming from Mark in Calgary. But to go back to my story, a couple of years ago, I was talking to you back when I was at BNN, and you were you were really pounding the table on gold, and nobody really cared about it at that time, and you held that conviction. Go ahead.
That's right. And here's the interesting thing. Canadian investors, I think, care about it, but American investors still aren't there. Amber, when the American investors get aboard this particular train, then watch out. So, Mark from Calgary, just you wait and see. When they get aboard, then particularly the juniors can go absolutely nuts.
So you are not taking profits. You are all in on gold.
I'm all in on gold, yes.
Do you have
now, right now, and I mean, if you're talking about the next month or two, we're in a period of seasonal weakness, okay? So everything doesn't go to just because I have a target up here doesn't mean it's going to go, in a straight line. It's going to walk upstairs, and that means there'll be some downs and some ups. Right now, I think we're sort of in a soft period in gold, and but I wouldn't worry about it. I would just be using it to accumulate some cheaper names, and there are some nice names around.
And we are going to talk about that because I think you brought a mining stock as a top pick.
I did.
But when you talk about gold being at $3,300 an ounce, what kind of upside do you see? Do you set price targets?
Setting price targets for, in my long experience in this business, setting price targets for commodities is a mug's game. They can go absolutely crazy, way beyond anything that is reasonable. And then, of course, then they have their own bear market. So I wouldn't set it, but I think I would just kind of ride along for the thing. You'll be able to tell when the Americans can't stand being out of the gold market and just have to get in, or when I remember how we knew the last peak in the gold bull market was when people were lined up outside of the Bank of Nova Scotia to buy gold. Okay, to actually buy physical gold. When you start seeing that, then you can sense that you're getting to an extreme. Too many people are getting aboard.
Well, they can buy it at Costco now. They won't be outside.
Well, exactly. I think
are we close? But there's no lineups for it yet.
No lineups. Although I understand Costco is doing just a landslide business in gold. Any time that they're able to get the stuff, they're moving it.
That speaks to the way the Canadian market is constructed.
Yes.
We're so over-indexed to gold. If they want to buy it on the S&P 500, you can go to Newmont. Like, where else can you go, right? So if you want gold, if the Americans are going to look for gold, they're either going to come to our index or the Australian. And it's the main reason the TSX has outperformed. So I'm wondering if your bearish comments on the S&P 500 extend to the TSX, because we're not just gold, or if you find relative safe haven in the TSX.
When I look at the TSX and I look at the fair market value for the TSX, okay, our index is here and the fair market value is up here. So
there's upside for the TSX.
Yeah, it's up about an easy 23-25%, I think, from there, and heavily, as you say, because we are weighted in commodities. And gold is one, oil, copper. I think all of these areas are promising.
Now, how does that work? How does the U.S. kind of collapse? Not they're going to collapse, but you see big problems for the U.S., but you can be bullish on oil and copper, which really live and die by like economic growth.
Well, that's partially true, Amber, and it's also partially not true. One of the real issues in the commodities sector has been underinvestment in that for a long period of time. And when you look at oil, and of course we everybody wants to kill the use of oil. Well, you're not going to kill the use of oil. It's important for too many areas. So there's been underinvestment in there for a long period of time, which means that there is a kind of almost a kind of a global shortage of it. And Canada is very well positioned, I think, to take advantage of that.
Just because I don't think you brought it as a top idea and we don't have a question on it, can I entice you to share a favorite oil pick?
I like the gas stocks, partially because there's an enormous spread between European gas prices and North American gas prices, and I suspect that gap is going to get closed as well, and that's the case there where the price of the demand for European gas isn't going to come down, so they're going to have to get it from North America.
Is that like an ARC Resources or, I'm going to make you name names?
Yeah. Let me Well, I really liked Parkland, but that's being taken over.
Yes.
Parkland is being stolen. Okay, if you look at the long-term chart of Parkland, you see that the stock has peaked out regularly at about 4 times book. It's being bought up at about just a little over 2. And it's been up there so many times in the past that you can't set your watch by it, but you can say when Parkland gets to 4 times book, sell. Well, it's as I say, it's dead cheap. That Simpson Oil Company, I think they got anxious, they got greedy. They accused Parkland of not running a good show, and the long-term evidence is they do, but it's too late now. It's disappearing into Sunoco, so too bad. P.K I.TO, a stock that
That was a hot Parkland take right in the middle of looking for a nat gas name, but I love it. Yeah, you're absolutely right. Simpson is now going to tender to the Sunoco offer. And it's fascinating. You say it's stolen.
I mean, if it were humanly possible, and I were a Parkland shareholder, and I could hold out, I'd hold out. The problem is that you don't want to hold out with 1% in the show. You'd have to hold out with 25 or 30, and maybe then you'd force a higher bid. But that's not going to happen.
Okay, so P.K I.TO. We'll leave it at that. P.K I.TO is the one that you like in nat gas.
Yeah. Paramount Resources.
Paramount, okay.
Yeah.
Right.
Baytex.
Even Baytex.
Even poor old Baytex.
Oh, no, I was thinking of Birchcliff.
Birchcliff would be another one.
Okay.
Yeah, these are, I think, look at the natural gas stocks, and I think that's where the best action is going to be.
Okay, so some bonus thoughts there. Let's bring it back on track to the mailbag.
Sure, yeah.
One question that we got a bunch of questions on the telcos. So I'll ask first about BCE and Rogers. This one coming from Cardi on X. I made out very well with your recommendation on Manitoba Telecom. So that was back in the day.
Back in the day, I'll say.
How about today's outlook for BCE and Rogers?
Okay.
I love that, the deep sigh right before.
Well, when you say BCE and Rogers, we're at kind of polar opposites.
Let's start with BCE.
Here, BCE has issues. Okay, they've been facing intensified price competition. They had way too much of a dividend, which they've now had to cut in half, which will help them a little bit. They are facing slower subscriber growth. There's regulatory challenges, making them share their network with newer, smaller companies. There have been some analyst downgrades and so on. And finally, when I look at the shape of the balance sheet, and you say, what the heck do you mean by shape of the balance sheet? I mean the trend of the balance sheet, and the trend of the balance sheet is going like this.
In terms of quality.
In terms of...
Not debt.
No. Well, they got debt there too. They got an awful lot of debt. But if I connect the dots, the book value of BCE, that's what I see. I see a falling balance sheet. I do not like buying companies with falling balance sheets.
So that's a no on BCE.
So that's a no on BCE. Now, the intrinsic value is quite a bit higher than it is now, but things have got to sort of improve for them. Analysts have been downgrading BCE for some time, and that puts pressure on the stock as well. So there's a general pessimistic outlook. Now, if we shift to Rogers, we get an equally ugly picture as far as the stock price is concerned, but not the balance sheet trend. The balance sheet trend for Rogers has been doing okay. So in point of fact, whereas BCE, the price has been falling and the balance sheet's been falling, there in Rogers, we have the balance sheets doing okay, and it's just the price falling. Well, now, remember, we had that jaws of death where we had, now we get the reverse jaws of death where we have fair market value up here and the price has fallen way down here. And that is usually closed by the price going up to the fair market value.
Because the fair market value has already been depressed.
Because the fair market value, the fair market value is not depressed. The price is depressed. So if you were looking for a telco to buy, I would say Rogers would sort of strike me as being something that you could put away comfortably. Don't if it's down 10% in the next 3 months.
Don't call you.
Don't call me and don't try to sue me. Not going to work. But in 3 years' time, you're going to do just fine. Thank you.
Now, let's talk about that in the context of Telus as well, because we did get a question on that. Please ask Ross about Telus, not so much about the future on the telecom side, but more so on the health, agriculture. Does it see a lot of growth in the non-telecom side of things? This is from LaFlamme123 on X. You're already laughing.
Well, because when I get to Telus, I get something that's sort of betwixt and between Rogers and BCE.
And it's held up better.
It has held up better, but when I look at the trend of the balance sheet, which you do, my charts, that's what they show. That's been sliding slowly way to. And here's the thing: the fair market value of Telus is exactly where the price is. So I can't say that the stock is cheap. It's been falling. The balance sheet's been falling, but I can't see a particular reason for buying it. Now, they have those two elements: the agriculture and the health, which I gather have been doing quite well. But Telus is also faced with the same problems that BCE has been faced with, and overall, I don't see the opportunity emerging.
So just for those that are just boning up on their financial literacy, when you are talking about the balance sheet going down, balance sheet is assets and liabilities.
Yes.
So you're talking about assets going down or liabilities
What I'm talking
increasing.
about is actually the equity per share.
The equity, yeah. Or the equity is
That's what I mean. Well, I look at the equity per share as being the support. That's but when you go to bed at night, that's your mattress is the equity, and what you want is to have equity rising under your feet. What you don't want to be doing is standing on something where it's sliding away under your feet. That's what you don't want.
So Rogers is kind of the outlier there in the
and
telecos.
Rogers is the outlier there. It actually is looking not bad, whereas Telus and BCE are slipping.
Okay, we've got a bunch more questions here. I'm going to take a quick break and we'll dip back into the mailbag. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, so our next question in the mailbag is Power Corp. Ross has recommended Power Corp in the past. Do you still like the stock? This one coming from Dave in Oshawa.
Yes, Power Corp is actually a member of our 2025 model portfolio. It's been doing very nicely. I think it's up about 18% or something so far this year. Not as good as some of the golds, but better than than some of those high tech stocks. Power Corp is a kind of a long-term turnaround situation. When Paul Desmarais died, the spark went out of Power Corp, and his boys took over. They were kind of happy to sit on some very, very first-class holdings, all right, but they weren't
like Great-West Lifeco, like IGM Financial.
exactly. But they weren't builders, not like Paul Senior. Well, that went on and on and on and on, and probably driving the shareholders mad. And finally, they convinced the boys to go and hire some professional managers and do something with the company. Well, I haven't seen yet what they might do with it, but the fair market value has been holding up nicely. The stock is very, very cheap. And
Even with the rally, close to all-time highs.
oh, mercy, going back 10 years and then go and see where Power Corp was back then, or 15 years, and you'll see that it was way, way up there. The stock is trading at a discount of about 40% to book value. In times past, Power Corp actually traded at a premium to book. So that is a long way to go. Now it's just sort of giving me a positive breakout in my technical work, telling me that maybe we're going to see some interesting things happening going ahead. So I'm very happy to have it in my model portfolio. I'm very happy to have it in my portfolio, and I think that stock should do well. And in the meantime, you've got a nice dividend too.
Yeah, what is it? I'm just going to look it up. People love to know about the dividends of their stocks. Power Corp's dividend right now, yeah, even with the stock at those all-time highs, is yielding almost 5%.
Exactly.
1.7%. So it's a nice dividend.
So if you get a 5% dividend yield and you start to get some growth there in the company, you could have yourself a real winner.
There's a lot of stuff in Power Corp. Like I mentioned, there's the financials. There's Great-West Life, which is its own publicly traded company. There's IGM, and then they've also got some renewables. Like there's just a lot in there. Do you like that conglomerate, or would you just prefer, why not just go to a Great-West Lifeco if that's the part of the business you're most excited about?
Oh, we hold that too.
Okay. So you're there.
Yes. I think that those incoming managers are probably taking a hard look, particularly the European side of things. Although the European stock market's been doing very well, so maybe they shouldn't, touch that. I think everything's up for grabs here.
Okay, so a lot of ways to unlock potential.
Yes.
Let's talk about...
You got a terrific balance sheet. You got everything going for you.
You love a good balance sheet. We're learning that.
I love a good balance sheet. The first thing I say to my clients when I get a new client, there are three things you need to look at. And the first thing is the quality of the balance sheet. If that doesn't pass muster, skip it.
Sometimes, though, you can make so much money in those garbage balance sheet stocks. Like a Carvana, for example, which is totally...
Oh, sure. Yeah. It isn't... It isn't a kind of a hard rule that you should only do that. However, if you don't do it, then you're going to get some nasty surprises.
That's a good perspective. Let's look at the balance sheet of Algoma Steel. This one, boy, has been a whipping boy in the tariff war, right? Because it's kind of on the outside looking in. Canadian steel producers, so it's going to be hit by those tariffs. It's going to be booted from the TSX Composite Index. So anybody who indexes to that index is kind of less of a reason to hold it. Do you see anything good here?
No. In a word, I don't see any positive earnings forecasts. And, number two, if number one was looking at the balance sheet, number two is going and look at what the earnings are going to be, and they better be there, and hopefully they'd better be growing. Well, if there's none of the above, then you've got a problem. And then the third thing you have to look at is the technical aspect of Algoma, and Algoma is rendering a signal in our work, which always warns me of incipient balance sheet problems.
Which is?
Oh, technically, if the stock drops below roughly a discount of about 40% to book, okay, about that. There's actually, it's quite a specific number. But if it drops, we'll say 40% discount.
Okay.
But if it drops below there, watch out.
Doesn't come back.
And I can go over the past 35, 40 years that actually I've got stock data for, and I can show you every instance of a stock that makes that drop. We call it a drop into the blue zone. When
the blue zone is bad.
The blue zone is bad, and it is a warning that there is a balance sheet problem. Sometimes, or the market thinks there's a balance sheet problem. That's and there are those instances as well. So it's not hard and fast. But when I see that signal, my inclination is to sell first and ask questions later, because usually I don't like the answer.
I am so fascinated to get your perspective on this next stock, just based on how you think and analyze stocks. Okay. We got a question from Raul on Instagram. What does Ross think about Lululemon's medium to long-term growth potential? This is such a volatile stock. I mean, just in the last week alone, it dropped 20%.
Okay.
On earnings that weren't great, but still.
Sure. Lululemon has such an interesting chart. I wish I could show it to you. Actually,
we're going to show it to our audience. So if you want to talk through a certain time
Okay,
horizon.
fine, good. All right. Well, I've got a picture of Lululemon, my chart of Lululemon in front of me. And when I see that, what do I see? I see this company sort of doing very nicely, but it's very volatile. It's it's down. It seems to always set back to its fair market value, and when it does, that usually is a signal that you can probably buy. Well, that's what Lululemon has just been doing, setting back to its fair market value. And if those earnings forecasts turn out to be true, then the stock is cheap. The implied return on equity, by the way, is 38%.
It's high.
That you can't sniff at that. Now the stock isn't cheap. It's trading up at about 8 times book, so it isn't cheap. But 8 times book and a 40%, almost a 40% balance sheet growth. Whoa, not. So
you
not
like it?
bad.
You would buy it? You take a run?
I would take a run. The only thing that I do have to warn you about is the last time that Lululemon dropped below its fair market value was in the sell-off in 2008. Okay, so the big bear market there, it really hammered the stock. But even in the COVID sell-off, never got below its intrinsic value, and that's where the intrinsic value, by the way, the fair market value is $250.
Is where the fair market value is, and the stock is currently trading at 262.
Yeah, well, the fair market value is 250. So that would be my target. That would be my target.
To start stepping in.
Yep.
Okay.
Yep, I'd happily do that.
Okay, the final question in the mailbag is Shopify. How do you, people who love the name say it's just going to eat the world, forget about the valuation. And then people who don't like the name can't forget about the valuation.
Well, that's the problem. When I look at Shopify, its fair market value is, hang on to your hat, 71% lower than the current price of the stock. Now, this company has an enormous balance sheet. When things were flying, I call this kind of company a Bay Street miner or a Wall Street miner. That is to say, when they had a very high price to book value, they issued stock. Mm-hmm. And so they kept on building and building and building and building the balance sheet, and they've got a terrific balance sheet. The problem is, so what are you doing with it? Well, the implied return on equity is not quite 12%. Now, we just looked at Lululemon up at 40, and by the way, also trading at about 8 times book. And we've got Shopify also trading at 8 times book, and its ROE is 12%. Like, really? How excited am I about a company like this? Now, maybe even if they tried issuing more stock, what good would it do? The balance sheet is so cash heavy now that you'd wonder, why am I paying management to sit on my cash?
Right.
That's the way I view it.
And you don't think, that ROE number is not impressive to you, the return on equity?
12% ROE? I mean, yeah, so what?
I guess you could go buy a bank for that.
Exactly. Precisely. We could buy TD or Royal or somebody like that. And yes, we would be very happy down there. And we would pay a fraction, a tiny fraction of the price, Shopify. So it's been recovering after it had an enormous sell-off, and it's been recovering and recovering and recovering. And there's been a bounce back in the earnings, no question. There was a sort of a V there. Was that? Oh, that was due. Yeah, that was due to the COVID. That was the COVID issue. So that's bounced back a little bit, but we're not looking at a company that you would want to sit on for 5 years. It's too expensive. As you say, you could sit on a bank in 5 years, and for sure you're going to win.
Okay, let's take a quick break here, and we're going to find out what Ross is enthusiastic about.
Okay.
ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right, now it's time for Ross Healy's ProPicks. Your first one is Fortuna Mining. So we know that you love gold. Isn't Fortuna silver?
It used to be called Fortuna Silver when it was 80 to 90% silver. What has happened is that the company has made a huge shift, and it's now little over 80% gold.
Okay.
And it's gold in a stable political environment. The fair market value is about double where the stock is currently trading at. It's cheap, and it's the kind of company that people would look at and say, well, I could just sort of tuck that one away, and I wouldn't have to worry about it because it's got a great balance sheet and it's cheap enough. It's about 1.5 times book value. What the heck, and it's in gold, so I don't have to worry about it. That's the kind of stock I think that you want to be in. For Mark from Calgary.
It had who loved, good memory. It was Mark in Calgary who asked about gold.
Yep.
It had a big run recently.
Yep.
you'd still like it here. It's still favorable on some valuation.
Oh
metrics.
well, gold's had a good run recently. As I say, I think we're in the seasonal softness in gold, but so that's a good time. You'd probably, for that, maybe for the next couple of months, if you're going to buy some, you might sort of accumulate it. Don't rush out and fill your hat with it, but accumulate it and hope that maybe in seasonal weakness it'll get a little bit cheaper.
Are they also? You mentioned the jurisdictions that they're in.
Yes.
Is it primarily Latin America?
No. Their gold mine is in the Côte d'Ivoire, the Ivory Coast, in Africa. And generally speaking, I avoid stocks in Africa, but the political situation here in the Ivory Coast is much better than many countries.
And they sold their assets in Burkina Faso.
Yes.
Did that help?
I don't think it particularly helped, and it wouldn't make any difference anyway. They could just write them off, and who cares? Their property in Ivory Coast is just. I was just going to say it was a gold mine, but I didn't.
You can say that.
I didn't mean to say that. Their undeveloped property shows terrific potential.
Right. Well,
Okay?
obviously it's
and that's important, because the problem with gold mines is that when you get the stuff out of the ground, then you have less and less and less and less in the ground. And in theory, then the value, the long-term value of your holding goes down. So you've got to keep expanding. Okay, you've got to keep expanding your reserves. And my favorite gold mines, that's exactly what they do. And they have just huge potential reserves there, which they have loosely tested, but have no idea how good they could be.
Do you have an upside potential? What's the upside potential of Fortuna?
Yes, but it's so big that I wouldn't know.
You can shock us. Go for shock and awe.
My immediate upside potential would be about $13. $13, yeah.
U.S.?
Canadian, I think.
Okay.
However, that would not be where I would expect the stock to go. I would expect to go much higher than that.
So the Canadian price is trading at $9.60. I just like to do the math for our viewers and our listeners.
I think 13 is an easy target.
Okay.
Okay. The harder target is when or occurs when we start getting Americans interested in the gold stocks, and they start looking at these kinds of stocks and they say, "Oh, I mean, here's a nice company. Okay, cheap, good earnings. Like what the heck? I can, I won't even think about that."
Okay. So tuck it away.
So just tuck it away. Yep.
Okay, this next one, nobody likes this stock. It has no buy ratings. It has 6 holds and 4 sells. It is Laurentian Bank. Nobody even wanted to buy the company. It did a strategic review.
Yep.
That review fell through.
Yep.
Tossed its CEO. Now there's somebody new there. Quarterly results showed profit was down almost 20%. But I think the stock rallied on those earnings.
I think the stock was, the market was happy that this company...
happy enough, we should say.
Happy enough to push it up. If I look at my own valuation chart of Laurentian Bank, it's trading at tied for bottom of a 30-year low. Well, when I see a company trading at a 30-year low, and I look at the fair market value, which by the way is I think it's something like 150% above where the stock is currently. It's one of those things that I think it's just a matter of time. If the market does nothing else, I think it starts to ooze higher. However, it's an outstanding purchase for another bank.
But none of them presumably they all kicked the tires and none of them did it.
Well, we don't know just exactly. The TD, for instance, is now effectively shut out of the United States to all intents and purposes. Where is it going to go here? If the TD owned the company, what would happen would be that by absorbing Laurentian into its balance sheet and its cost structure, my guess would be that the ROE of the company would double in a flash.
We're in for a period of economic difficulties. At
Yes.
least that's what the forecasts say. And you're nervous about what happens in the U.S. So how does arguably the worst of the banks do well in that environment?
It's so cheap and has such a nice dividend that in a sense you've got other problems.
Does the dividend at 6% is sustainable?
Yes, it's well covered.
The
it's already been cut, so it's well covered now. Yes.
The other thing I wonder when it comes to Laurentian Bank, you mentioned that it may be an acquisition target, that it's cheap enough that even in a disappointing economic scenario, it potentially does well. What about the fact that, we don't really know where growth comes from? You need the bank to ultimately do well with profit falling. Does it need to turn around in order for the stock to do well?
I don't know whether it needs to turn around. I think its crippling feature is size.
That it's too small.
It's too small. Yes, and when something is too small, what does it mean? Well, okay. How do we get bigger? Well, they already tried that. Put themselves up for sale. You can muddle along quite happily, and if you're cheap enough, and you've got as I say, you've got a very cheap stock and you got a nice dividend, you can just sit on the thing. That's what I'm doing.
You mentioned that stocks that you won't touch. This is trading at a 30-year low.
Yep.
Stocks you won't touch are when they're trading 40% below book value. That they fall into a blue zone, which is a bad zone.
Yep.
Is Laurentian?
It certainly is.
Okay.
It's certainly down in the blue zone, and
but you're going to be a hero in the blue zone with Laurentian.
Well, there are great opportunities in the blue zone. The volatility of what I call blue stocks. The volatility of blue stocks is right out of sight. It typically can be as high as can be up as 100% in a day and down 50% in a day. So it's a great place to find interesting value, but you've got to do a lot of work. Okay, you just can't buy any blue stock and make money on it. You have to, and there have been investment managers who specialize in buying these kinds of stocks, but you've got to do a lot of fundamental analysis. And so we've done the fundamental analysis.
And it's good. Okay, so that's one of your picks. The third one has done better. It's ATCO. Distributes electricity projects, kind of Canada, UK, Australia.
Yeah.
That's almost boring compared to.
Well, ATCO is boring, but I was looking for something to kind of anchor our portfolio, and a nice utility stock with a decent yield, not exciting, but a decent yield. Cheap relative to its own history. That's the kind of thing that you can put in your portfolio and go to bed at night and not worry. And if it sets back a bit, so what? You know perfectly well that in a year or two you're going to be comfortably on side. So those are the kind after when you've got a lot of excitement in Fortuna and you've got a turnaround in. Potential turnaround in Laurentian, you want something, as they say, that just says, it just sits there and just plods away.
Yeah, that's what it helps you sleep at night. It's like, it's okay,
And that's
but
exactly,
I have ATCO.
that's what helps you sleep at night.
We haven't talked about this, but like, how concerned do you need to be about the bond market? If there's, a spike in yields, these utilities can be vulnerable because, you can get higher interest rates elsewhere and something even more stable.
Yes, and certainly that's absolutely true. I would be more concerned about the utilities if I was in the United States, because I would be more concerned about the spike in their yields there than I am in Canada. Right now, we seem to have the Bank of Canada in our corner as far as the utilities are concerned, as far as yields are concerned.
Ross, what an absolute pleasure. Thank you so much. I really enjoyed talking to you again.
Amber, this has been fun.
That's Ross Healy of Strategic Analysis Corp. Now, make sure you tune into our next episode. We're talking all about oil and gas, and there is a lot to talk about right now, especially with the takeover offer for MEG Energy. And you know who said that MEG was probably a good candidate? Our upcoming guest. That's Cole Smead of Smead Capital. He's coming back, joining me in studio for a talk about that deal, as well as what other opportunities he's finding in the energy sector, especially as oil prices have started to drift higher. So if you've got questions, you can email us at questions@inthemoneypod.com, or you can find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.